Disclaimer.
On January 1st, 2025, China did something that sent shockwaves through the global silver market. They placed silver under state trading export controls. Translation? Beijing told the world we're locking down our silver supply. Analysts predicted shortages. Industrial manufacturers panicked. Silver prices started climbing. But then in October 2025, just 9 months later, China did the unthinkable. They exported 660 tons of silver in a single month, the largest export volume on record, straight to London, the exact market they were supposedly cutting off. This wasn't a policy change. This wasn't a gradual relaxation of controls. This was an emergency dump, and it failed spectacularly. Because despite flooding the market with 660 tons, silver didn't crash. It didn't even slow down. Instead, it hit $66.21 per ounce in December, the highest price in history. So what's really happening? Why did China reverse course so dramatically? And why didn't their massive supply injection work? Let's rewind to January 2025 and understand what China actually announced. Their Ministry of Commerce declared that silver exports would now require state approval, the same framework they used for rare earth metals, a system where Beijing can turn the tap on or off whenever they want. The message was clear. China was prioritizing domestic needs. Their solar panel industry, which produces over 80% of the world's solar panels, needs massive amounts of silver. Each panel requires about 20 grams of silver paste for electrical contacts, and with China installing record solar capacity in 2025, industry analysts expected Beijing to hoard every ounce. But here's where the story gets strange, where the official narrative completely falls apart. By October 2025, something broke. China didn't just ease restrictions, they opened the floodgates. 660 tons poured out in a single month, primarily to the London Bullion Market Association. To put that in perspective, China's monthly 5-year average export is around 310 tons. This was more than double that. This was panic. But panic about what? What could force the world's manufacturing superpower to reverse a strategic resource policy in just 9 months? The answer is in Shanghai's stockpile data, and it's terrifying. While China was exporting record amounts, their domestic silver inventories on the Shanghai Futures Exchange were collapsing. From 3,091 tons in January 2021 to just 780 tons by December 2025. That's a 75% inventory wipeout in less than 5 years. China wasn't restricting silver exports to build reserves. They were restricting exports because they were running out. And when London's market seized up, they had no choice but to raid what little they had left. Here's what happened behind closed doors in October 2025, the crisis that forced Beijing's hand. The London silver market, the world's largest over-the-counter precious metals market, was experiencing what traders call a physical squeeze. Inventories were so tight that buyers were paying massive premiums just to get metal delivered. According to Zijie Wu, analyst at Jinri Futures Co-Nars, the crisis stemmed from rising exports to London, combined with elevated industrial and fabrication demand. London was screaming for silver, and the premium they were offering made it impossible for China to say no. Remember, Shanghai silver was already trading at a 15% premium over Western prices earlier in 2025. That spread compensated for China's 13% import tax, and then some. Chinese traders were already incentivized to import silver, not export it. But when London offered even higher premiums, the arbitrage became irresistible, or more accurately, necessary to prevent a complete market breakdown. Daniel Gawley, senior commodity strategist at TD Securities, explained it perfectly. A wave of imports into China is going to drain the free float away from the West even further. Except in October, the wave reversed dramatically. China became the supplier of last resort. They exported 660 tons to keep London's market from completely seizing up, to prevent the global pricing mechanism from disintegrating. But here's the critical detail most analysts missed. This wasn't a strategic move. This was damage control, an emergency intervention to prevent systemic failure. Why? Because even after injecting 660 tons, roughly $37 billion worth at October prices, silver prices kept climbing relentlessly. On November 26, 2025, spot silver traded above $52 per ounce. By December 18th, it hit $66.21, a new all-time high that shattered the previous record. Think about that for a moment. China dumped the equivalent of 21 million ounces into the market, and prices went UP, not down. That tells you everything about the supply-demand imbalance we're facing. The industrial demand, particularly from solar, EVs, and data centers, is so strong that even China's emergency stockpile releases can't satisfy it. And now we have confirmation. China's Shanghai stockpiles have collapsed 75% since 2021. They exported 660 tons in October alone. and their domestic solar industry is consuming more silver than ever before. So here's the terrifying question nobody wants to ask. What happens when China runs out completely? Let me show you the mechanism that's really driving this market, the death spiral that's already in motion. Stage 1. China imports heavily. December 2024 saw 390 tons, a 3-year high. Stage 2. Domestic solar boom consumes stockpiles faster than imports can replace them. Stage 3. Shanghai inventories collapse, down 75% since 2021. Stage 4. London experiences physical squeeze. Stage 5. China exports emergency supply to prevent global market breakdown. Stage 6. Prices continue rising anyway because the structural deficit remains. This isn't a cycle, it's a death spiral with a mathematical endpoint. And we can prove it with hard numbers that don't lie. According to the Silver Institute, global silver deficits have persisted for 5 to 6 consecutive years. The 2024 deficit was 215.3 million ounces, the second largest in over 20 years. Industry analysts project that if China reduces exports by just 50%, global deficits could exceed 5,000 metric tons annually. But China didn't reduce by 50%. In October, they increased exports by 213% versus the monthly average, and it still wasn't enough to bring prices down. Here's what that tells us about the true state of this market. The system is structurally broken. Demand from industrial applications has permanently outstripped mine supply. And China, the world's swing supplier, is now scraping the bottom of the barrel. Shanghai's stockpiles, 780 tons and falling every single day. China's production, 3,300 tons in 2024, down from 3,400 in 2023. China's consumption, 19,000 tons in 2024. That's a 15,700 ton deficit that can only be filled by imports or inventory drawdowns. And we just watched them draw down 660 tons in a single month to save London's market. The export restrictions weren't about hoarding silver for strategic advantage. They were about survival, about keeping their industrial base functional. Beijing knows their domestic industry can't function without silver. Not their solar panels, not their electronics, not their military applications. But they also know that if London's market seizes up, it triggers a global supply chain collapse that hurts everyone, including China's export-dependent economy. So they sacrifice their stockpile to keep the system running, to prevent the pricing mechanism from completely breaking down. But here's the problem that keeps commodity strategists awake at night. You can only do that once, maybe twice if you're lucky. After that, the math takes over, and the math doesn't negotiate. Let's verify everything I just told you with hard data that can't be disputed. According to Trading Economics, silver closed at $67.14 per ounce on December 19th, 2025, up 127.54% compared to the same time in 2024. That's the strongest annual gain since 1979, the year silver hit its inflation-adjusted peak during the Hunt Brothers squeeze. But this isn't manipulation. This is mathematics playing out in real time. China's silver production in 2024, 3,300 metric tons according to CEIC data. China's silver consumption in 2024, 19,000 metric tons according to Indexbox. That's a 15,700 ton deficit every single year. And China isn't unique in this crisis. The global picture is even worse. The Silver Institute projects global mine production at 823.5 million ounces in 2024, down 0.8% year over year at a time, when we desperately need supply growth. Meanwhile, global industrial demand is hitting record highs across every major sector. Solar panel production is up 20% in 2024. Electric vehicle production is projected to use 100 plus million ounces by 2030 at current adoption rates. Data center construction is accelerating due to AI infrastructure build-out, each facility requiring significant silver for electrical components. Metals. Focus forecasts show the market deficit persisting through 2026 and beyond, driven by rebounding industrial demand, ongoing strength in solar applications, and modest supply growth. Translation: we're not mining enough silver to meet current demand, and demand is growing faster than supply can possibly respond. Now layer in China's stockpile collapse, and you'll understand why the October export was so shocking. Shanghai Futures Exchange, warehouse data verified by CEIC, shows the complete picture. January 12th, 2021 held 3,091.112 tons, the all-time high. December 11th, 2025 shows just 786 tons remaining. That's a decline of 2,810 tons, a 75% collapse in visible inventory. That's not a drawdown. That's a liquidation, a desperate burning of reserves. And remember, this happened while China was implementing export restrictions, supposedly designed to protect domestic supply. The restrictions didn't work because the deficit is structural, not cyclical. You can't policy your way out of geology. Here's where the story gets even more revealing, where we see the global silver network in action. While China was exporting 660 tons in October, India was on an unprecedented silver buying spree that shocked commodity analysts. According to Korea's analysis, India imported over 2,600 tons in just September-October 2025. Let that sink in. 2 months, 2,600 tons. From where did this massive wave of metal originate? United Kingdom, 1,000 plus tons. Hong Kong, 880 plus tons. Switzerland, 225 tons. UAE, 140 tons. Notice anything? A massive chunk came from Hong Kong, a traditional routing point for Chinese silver headed to the London Bullion Market Association. Industry analysts suspect that a significant portion of silver arriving in India from Hong Kong is actually leased Chinese silver that was routed through London and then re-exported to India. Why does this matter? Because it reveals the real flow of metal, the actual pathway of this emergency supply chain. China exports to London, 660 tons in October. London processes and routes to India via Hong Kong and other financial centers. China didn't reverse their export policy to help the West. They reversed it because India's industrial boom created demand that London couldn't satisfy from Western sources alone. India is installing record solar capacity as part of their renewable energy transition. Their economy is growing 8 to 10% annually. And unlike the West, Indian consumers prefer holding physical silver over depreciating rupees, creating both industrial and investment demand. So when Indian industrial buyers and retail stackers come calling, someone has to supply them. And in October 2025, that someone was China, bleeding their stockpiles to keep the global market functional. But here's the critical insight. Even this emergency injection could not stabilize prices or calm the market. Indian silver futures. For March 2025 delivery, hit Rs1 92,615 per kilogram, reflecting global scarcity and investor hedging against further supply disruptions. The premium structure tells you everything about the desperation in physical markets. Shanghai silver maintained 15% plus above London prices throughout 2025. Indian futures showed massive premiums reflecting domestic scarcity. Physical delivery delays stretched to 2 to 3 weeks in some markets. This is what a structural supply crisis looks like in real time. Not a temporary squeeze that resolves when speculators exit. Not a speculative bubble driven by momentum traders, but a fundamental mismatch between geology, what we can mine from the earth, and technology, what industry demands to function. If you want to understand where this ends, look at what China already did with rare earth elements, because they're following the exact same playbook. In 2010, China controlled 97% of global rare earth production. They used export quotas to dominate the market and secure strategic advantage. The result? Rare earth prices exploded overnight. The global supply chain restructured at enormous cost, and Western countries launched desperate efforts to develop alternative sources. Sound familiar? It should, because we're watching the same movie play out with silver. China currently produces about 3,300 tons of silver annually, making them the third largest producer behind Peru and Mexico. But they consume 19,000 tons annually. That 1,700 ton deficit is filled by imports. Exactly like rare earths before the export restrictions triggered the crisis. The difference? With rare earths, China had stockpiles to deploy as a strategic weapon. With silver, their stockpiles are nearly exhausted. Shanghai Futures Exchange data shows just 780 tons remaining as of December 11th, 2025. At their current consumption rate of 19,000 tons per year, that's 5,183 tons per month. That represents less than 2 weeks of supply. Even if we assume they have additional off-exchange inventories, which analysts believe are quite large but unquantified, the trend is unmistakable and terrifying. China is running out. And when they run out, one of two things happens, both of them catastrophic for price stability. Option 1, Chinese industrial production slows dramatically. Solar, EVs, electronics, all face supply constraints. Option 2, China bids up global prices even higher to secure imports, sparking a bidding war with India, the West, and other industrial nations. Neither option is bullish for price stability. Both options are explosive for silver, but here's what makes this different from rare earths, what makes this crisis potentially more severe. You can't easily substitute silver. Rare earths had alternative materials for some applications. Engineers found workarounds. Silver doesn't have that luxury in its critical applications. It has the highest electrical conductivity of any metal. Period. No exceptions. No close seconds. It has the highest thermal conductivity of any metal. Period. Physics doesn't negotiate. It has unique antimicrobial properties that are irreplaceable in medical applications. No other element can do what silver does. For solar panels, you can't use copper paste. It oxidizes and kills efficiency. Panel performance drops 20-30%. For high-frequency electronics, you can't use aluminum. Resistance is too high. Devices don't function properly. For certain medical devices, you can't use substitutes. Infection risk is too high. People die. This is why even a 660-ton dump from China couldn't stop the rally, couldn't even slow it down. The demand is non-negotiable. Industry needs silver to function, and the supply is finite, increasingly concentrated in fewer hands. The math is simple. The consequences are not. Let's do the calculation everyone's avoiding, the math that reveals exactly how little time we have left. China's remaining Shanghai stockpile, 780 tons as of December 11th, 2025. China's annual consumption, 19,000 tons. Monthly consumption, 1,983 tons. Days of supply remaining, 14.8 days. Less than 2 weeks of visible inventory. Now before you say, but China has off-exchange inventories, you're absolutely right. They probably do, held in strategic reserves and state warehouses we can't see. But here's what we know for certain, what the data proves beyond doubt. Shanghai visible inventory has collapsed 75% since 2021. China exported 660 tons in October, draining hidden stocks to save London's market. And consumption is accelerating, not slowing. The solar boom continues expanding. Even if China has 5,000, 10,000 tons of hidden inventory, and that's a generous estimate, we're talking about months, not years, before exhaustion. And every month that passes, the deficit compounds. The hole gets deeper. Let me show you the timeline of what's coming based on current consumption rates and deficit trends. January 2026. Shanghai stocks likely fall below 500 tons as industrial demand surges post-holiday. February 2026, China either restricts exports again or raises bids for imports, triggering a price spike either way. March 2026, global spot markets face physical delivery delays as supply chains strain under pressure. Q2 2026, price discovery breaks as paper markets decouple from physical. Futures contracts settle in cash because metal can't be delivered. This isn't speculation. This is arithmetic playing out in slow motion. The global silver market deficit in 2024, 215.3 million ounces, equal to 6,995 tons. Expected deficit in 2025, similar or larger, with solar demand up 20% year over year. Expected deficit in 2026, accelerating as EV adoption increases and data centers multiply. Now add this critical variable that changes everything. The U.S. Geological Survey added silver to the critical minerals list in 2025. Why does that matter? Why should you care about a bureaucratic designation? Because it enables the U.S. to apply tariffs on silver imports under national security frameworks, the same authority used for steel, aluminum, and rare earths. If U.S. going to China trade tensions escalate in 2026, and that is highly likely given the political calendar and ongoing tech competition, silver becomes a geopolitical weapon, a chess piece in a much larger game. China plays their card. We'll restrict silver exports unless you back off on tech sanctions and semiconductor restrictions. U.S. responds, we'll tariff Chinese solar panels and electronics unless you release silver supply. And caught in the middle, every manufacturer, every investor, every industrial user worldwide watching prices spiral. The price goes to wherever it needs to go to destroy demand. And with solar, EVs, and AI infrastructure all requiring silver, that price might be much higher than $66. Technical analysts are looking at the gold to silver ratio for clues about where we're headed. Current ratio, 65:1 as of December 2025. 80-year historical average, 60.1. Crisis period average, 40.50.1. If gold stays around $40,300 per ounce, the current level in December 2025, and the ratio reverts to 60.1, silver should be at 71.67 per ounce. If the ratio compresses to 50.1 in a panic buying scenario, silver should be at $86 per ounce. But those are equilibrium calculations. They assume rational markets, orderly adjustment, patient participants. What if this isn't rational? What if China's stockpile exhaustion triggers a genuine supply emergency? In 1979-1980, silver went from $6 to $50 in just 12 months, a 733% gain driven by the Hunt Brothers corner. In 2025, silver went from $29.50 in January to $66 plus in December, a 123% gain in 11 months. If the rally continues at even half the pace into Q2 2026, we're looking at $95 to $105 per ounce. And analysts tracking Chinese commodity policy suggest this is entirely possible. According to recent analysis from market watchers, Price projections based on historical gold-silver ratio insights suggest potential advances to $200 to $300 per ounce within 6-month timeframes if supply disruptions persist. I'm not endorsing those targets, but I'm telling you they exist in serious research from credible strategists. Why? Because when a structural deficit meets geopolitical restrictions, price is the only mechanism that can balance the market. You either raise prices high enough to destroy industrial demand, forcing substitution or conservation, or you physically run out. There's no third option, no middle path, no compromise. And based on China's October panic export, based on their collapsing stockpiles, based on India's massive imports, based on the persistent global deficits, running out is a real possibility. Here's what to watch in the coming months, the specific indicators that will tell you if this crisis is accelerating. January 2026. Monitor Shanghai Futures Exchange inventory every week. If it drops below 500 tons, we're entering crisis territory where emergency measures become likely. February 2026. Watch for Chinese export license approvals. If they tighten again after the October emergency release, it confirms stockpile exhaustion and signals desperation. March 2026. Track physical premiums in Shanghai, London, and New York. If premiums exceed 20%, the paper markets are losing control and physical scarcity is taking over. Q2 2026. This is when the math breaks completely. Either China finds new supply sources, which is unlikely given global mine production trends, or prices spike to demand destruction levels. The institutional players already know this. They're positioning while retail investors are still trying to understand what's happening. JP Morgan paid a $920 million settlement in 2020 for manipulating silver markets. They're not doing that for fun or small gains. They understand the long-term supply dynamics better than anyone. Central banks globally bought over 1,000 metric tons of gold for the third consecutive year in 2024. Silver is following the same safe haven bid as smart money diversifies. And retail investors are catching on. ETF inflows hit record levels in 2025, with both institutional and retail piling in as awareness spreads. China's 660-ton October dump was supposed to calm the market, to restore confidence and bring prices back to earth. It failed completely, because you can't dump your way out of a structural deficit. You can't export your way out of geology. You can't policy your way out of physics. The question isn't if silver breaks $100. The question is when, and whether you'll be positioned before it happens, before the crowd realizes what's coming. Shanghai's stockpile, 780 tons and falling every single day. Global deficit, 6,695 tons, and growing with each passing year. Time remaining, months, not years. The math doesn't care about your opinion. It doesn't care about skepticism or hope or fear. It only cares about supply and demand. And right now, demand is winning by a landslide.